but that's what I hear. So anyway, we've still got a few people that are coming in. Thank you so much. This is TMC Connect. I am Tony Bramley, Business Development Coordinator here at TMC Connect. And today we have John Sayer and Britt Haven with us from FBX, Informa Solutions, Informa Financial. I always want to call it Solutions for some reason. They are going to tell us the so what for first quarter 2021. I hope you are here to listen and get the numbers for the first quarter of 2021 and see how you're doing up against your peers. So if you guys will give us just another minute, we're almost there. Want to get some housekeeping out of the way. You have come in on mute, but if you would like, and we would love for you to engage with our discussion leaders. So please type your questions in the chat or the Q&A, and I will read those out to Britt and to John once they have concluded their presentation. And with that, I will turn it over to Britt.
Awesome. Thank you so much, and good afternoon, everyone. Let me go ahead and share my screen here. You want to see that okay?
Yes.
All right, great. Again, as Tony said, my name is Britt Haven. I'm the Sales Director of Mortgage Solutions here at FBX, Informa Financial Intelligence. And then I've also got John Sayer, who is our VP of Client Success, on the line as well. So he and I both work together on the sales side as well as with existing clients in understanding and leveraging the data. So today, the so what's we're going to be talking about. We're going to look at tracking operational cycle times, monitoring market margins, the purchase market trends that we're seeing, and the market reaction to the GSE delivery restrictions, all for Q1 of 2021. And before we dive into the data, just a little bit about what the data we're looking at is, where it's coming from. Our lenders benchmark originations data is all lender sourced. We collect app lock and funding loan level data from lenders on a weekly basis. And the data covers about 50% of the retail market. It includes national banks, regional banks, IMBs, credit unions. And again, because we're covering about 50% of the retail mortgage market, that is a statistically significant amount of data. And again, it helps with understanding lenders' performance from a market share perspective, operational efficiencies, business mix, pricing competitiveness. Additionally, that's the bulk of the data we're going to be looking at, but also we also have on the pricing side our rate surveys. That is, again, all lender sourced. The rate sheets come directly from lenders on a daily basis. We've got about 250 lenders that participate in this nationally. And again, it's a makeup of national banks, regional banks, IMBs, credit unions. We have it for retail, wholesale, and correspondent. But again, the daily rate sheets help our lenders understand and get timely competitive rate information, understand their pricing position by loan attributes. So again, that's where the data is coming from. And then I'm going to have John do a quick recap of Q1 2021 based on our benchmarking data.
Awesome. Thank you, Britt. Thanks, TMC, for having us. Appreciate it. Before we hit the 4 topics that Britt outlined there, we just thought we'd step back for a moment and give you a macro view of where we stand in the first quarter of 2021, both comparing it relative to the same period last year and also the fourth quarter of last year, quarter over quarter. So when we look year over year, we see for the first quarter, 347 billion. That's a denominator. That's our benchmark. That's how much we have tracked in funded loans. Again, lenders source that directly, that data to us directly. We aggregate that together. You're looking at a 74% year over year, first quarter of 2020 versus 2021, 74% increase overall in funded loans. How that compares to the fourth quarter, though, is relatively flat, up about 2.6% quarter over quarter. So volumes still very, very strong, obviously, for first quarter relative to the fourth quarter. We broke this down a little bit. And of course, we'll send this information along and it's available to you so you can refer back to it. But we looked at centralized business model, the branch model versus decentralized. And you can see here for branch up 53% year over year, and then the call center or centralized model up 117%. In the fourth quarter versus first quarter of this year, you do see branch down a bit, down 4% marginally, and the call center still having that huge refi overhang with a 14% quarter over quarter year over year growth. Lender type, financial institutions up about 36% year over year, quarter one over quarter one. Mortgage banks up 114%, so about 3 times as much. Obviously, mortgage banks were able to get loans pushed through the pipe much faster than financial institutions were, generally speaking. We'll see that in our cycle times. But really interestingly, though, for the first quarter of 2021, you see financial institutions being relatively flat quarter over quarter, and then mortgage banks being up just 4%. So we're seeing in the first quarter of this year, things kind of normalize between those two lender types. And then I'll mention here just you can see the breakdown of what we've tracked in terms of purchase transactions. So 28% of that 346 billion that we tracked for the first quarter of 2021 is purchase transactions. That's up 33% over the same period last year. It is down from last quarter, 22%, but that's really a seasonal effect. And then, of course, you can see the refinance numbers there as well. So what? Really, the first quarter of 2021 volumes exceeding the fourth quarter of last year, despite rates running up a little bit here. We do have funded purchase transactions down here in the quarter, but that's really due to seasonality. And then I think the biggest so what here is mortgage banks and financial institutions kind of equalizing their volumes in terms of their trends. And again, we'll provide this after the call, but this is a quick look at year over year, first quarter of last year versus first quarter of this year for just the East. You may remember the national number was up 74%. You can see here that the East was the winner versus the West. You can see the states that we put in the Eastern segment of the country there, up 84% year over year. And then again, the numbers down the line here, pretty much why would you care about this? Well, if your volume was up 100% year over year, you're able to say, hey, I outpaced the general market, which we're tracking again over half of all originations, which as you'll see is very statistically significant as we go through the different business cases here.
Great. Now we're going to look at operational cycle times for the first quarter of 2021. Actually, we're going to start by looking at a little bit of a history. So this graph here is just showing starting from January 2019 through the end of Q1 of 2021, kind of where refis from an app to fund cycle time have trended. And, obviously, as we got into the beginning of last year, they had kind of started to increase, then dropped down in March of last year, and then creeped back up as the volume continued to increase heavily throughout the year from a refi perspective. Now we're seeing it again start to come down and taper off despite volume still being high as lenders are gaining a little bit more capacity, clearing out their pipelines. Things are starting to shift from a refi to a purchase market. And this is for all refis, app to lock fund, app to fund cycle times for all different product types from a refi perspective. Looking at just this past quarter, looking at conforming refi transactions, we'll see at the beginning of the year, the beginning of the quarter, we were up at over 76-day turn time. We did drop down back in late February, all the way down about 68 days. Started to creep back up on the conforming, but kind of staying around that 73-day mark. And again, this is again partially because there's more capacity, and again purchases are starting. The market's starting to shift towards purchase market. Govies, kind of a similar but more exaggerated graph here. Obviously, these turn times are about 20 days faster than conventional. Kind of taking a dip in the beginning of March, end of February, spiked back up late March, and then you'll see it's kind of leveling out here around 54 days for the last few weeks. Non-conforming, that probably had the largest swing in turn time drops, but obviously at the end of last year, beginning of this quarter, we saw turn times up at almost 100 days. Some were significantly higher than that. Now they're leveling off around a little over 80 days. And again, this is probably mainly due to the fact that there's more capacity from a bank perspective as we're getting through the end of this quarter.
All right, so we're going to touch base here on margins. Obviously, lenders price margins differently. Some lenders have models that are very branch oriented, some are regionally oriented, some are corporately set, or some combination of that. What's important though is establishing benchmarks to really see how your distance from market is trending, whether the market's moving away or towards you with regard to competitive pricing. So we're going to share with you a few views here, a combination of our rate data and also our origination data. So rate data is where lenders advertise prices, and then of course origination data is where things are actually getting locked and funded. This is lock information. I think this is fascinating. I didn't really have an appreciation for how different products are behaving from a price perspective. This is looking over the first quarter. You can see early in the quarter, the lines there. Let's focus just on the thick blue line and compare it to the orange line. So what we're looking at here is agency jumbo, non-conforming 30-year versus conforming 30-year. So the dark, the thick line is the non-conforming or jumbo 30-year. You see a 2 7/8 kind of at the beginning of the year as the average rate. That has trended up to 3 1/8. So you see about a 1/4 increase in note rate, average note rate from beginning of year to current date. That's on locked loans, what actually got locked in. And then for conforming as a comparison, you see about a 2 3/4 initial note rate there, trending up to 3 1/4. So that's a 50 basis point increase. So if you think about it, non-conforming rates up 1/4 year to date, conforming up 0.5% year to date. So a much different story on jumbo, and as I'm sure many of you read the Chrisman report and other news sources, a lot of conversation in the market around jumbo loans and kind of a race to the jumbo products. We have a few different views here. We're going to hit conforming, some govy, and then again jumbo. This gives you a sense of the average rate just in isolation for 30-year fixed conforming year to date. That approximately 2 3/4 up to about 3 1/4 that we talked about. What's interesting though, in the last week, the bottom chart there, in the last week, this is showing you what note rates got locked in for conforming 30-year fixed. And that's that was last week, basically, as of the 7 days prior to last Sunday. And the predominant note rate there, 3 1/4 note rate, with a good amount of business being done at the 3 note rate, 3 1/8, 3 1/4, and 3 3/8. My background, secondary marketing from back in the day, really, I think a careful analysis of what note rates are getting produced in the market, I think really gives you a good sense of competitiveness and where the greatest market opportunity is. Here, obviously, we see the predominant 24% of the loans getting locked in at a 3.25 note rate. Of course, in our data, you could control for any kind of variables, credit score, loan amount, lock period, purchase, refi, non-owner, cash out, things like that. Here's the average rate for government 30-year purchase transactions. Again, these are just purchases, so we're out of the refi world. We really focused on the refi on the cycle times because that's really your variable operational component. For the rate information, the rate intel, we just are looking at purchase. And the reason for that, again, as refinances maybe fade away a bit, people will be hyper sensitive to the purchase market. We wanted to give you all some insight into what's going on in that market. Here's purchase transactions for 30-year fixed govies. Again, you can see the trending on the top year to date, and then on the bottom, you've got the rate distribution of what locked in last week. We do see that predominant note rate being a 3.25 note rate. Almost 20%, 19% of the business got done at that note rate. But we do see a much wider dispersion of note rates being produced in the government market. That's a function, I believe, I know, of loans getting priced differently by credit score and wide variations around credit score pricing. So, but you do see the predominant note rate getting printed right now at the 3.25 note rate. If we were to just show refinances, you may see that weight a lot differently, probably a 2.75 note rate. And then finally here for the jumbos, again, purchase transactions, you can see what rates have trended as you start rolling out or maybe expanding your purchase, your non-conforming offering. Hopefully this data is fairly useful to you to see how competitive your rates are. This is what we saw in terms of locks year to date on the top. And then again, last week, we saw the predominant note rate getting locked in at 3 1/8 note rate. And then you can see that even loans as low at 2 3/8 were locking last week, jumbo loans as low as 2 3/8. And you run the gamut there up higher, but predominantly 3 to 3.25 note rates getting produced. And then what I'm going to share with you right here, I think is a good way to monitor margins. And really, I think the message here is establish whatever benchmark you have accessible to you, whether it's what we do in our rate survey by named lender, and maybe you pick off 5 competitors that you think are your closest competitors. You create some kind of price average of those competitors and monitor your distance from those competitors. And certainly what we do, look at the origination data, what your average rates are relative to others in terms of what you're locking in, or if there's other data sources that you might have, maybe looking at websites, but creating that benchmark against yourselves and then looking at your distance from that benchmark. And again, if it's self-sourced information from people's websites, or if it's a service like ourselves, which is, you know, we do rate surveys and then we have this origination data as well. But you can see on this chart here, that growing gap. If you don't change margin and you see the market starting to move away from you, really good indication that margins are compressing and that you're becoming less competitive.
Now we're going to take a look at even further deep dive into the purchase market trends, what we're seeing. So this is looking at the last 12 months versus the prior 12 months. So Q2 of 2020 through the end of Q1 2021 compared to Q2 of 2019 to Q1 of 2020. Again, just think it's pretty interesting. While we obviously are seeing significantly more volume in this last 12 months, the it's still similar, following a similar trend. Just kind of emphasizing that the purchase cycle is cyclical. And then we're going to kind of just drill down into a couple different things. So this is comparing year over year funded volume within our benchmark. So this is looking at the first quarter of this year compared to the first quarter of 2020. Just breaking it down for purchases, conforming, government, and non-conforming. Obviously, every fixed rate products are all up. Adjustable rates are down by a little bit. But you can see here that there's a strong rebound for the non-conforming jumbo market. It's actually, the growth and volumes actually exceeded government loans from a funding perspective this quarter versus Q1 of 2020. And again, this is just kind of that in a graphical form of looking at this past quarter's production compared to Q1 of 2020 production. Again, showing it's obviously there's been significant more volume, but the cycle trend has kind of followed in suit. And then looking at locks, again, funding is kind of what happened. Locks kind of showing what is happening. So again, here you can also see that there's even more growth in the non-conforming space as it compares to the other, where non-conforming is up by about 65% this quarter compared to Q1 of 2020. Now we're moving through these pretty quickly here. We will, just as a reminder, we are going to provide the slide deck after the webinar, so you'll be able to have all of this data once webinar is over. Again, this is kind of the same graph here showing this quarter locks compared to 2020's Q1 locks. Again, following a similar trend, just a lot more volume. Then here, this is, again, based on our benchmarking data, this is showing the top 25 purchase volume states for Q1. And this is, across all products here. So California's kind of got the largest market share here at about 21.5%. Florida, Texas, New York, shortly behind there. And again, this is a distribution of our benchmark, which is obviously not equally, across all states in general. Looking at it from a product mix, again, this is purchase volume, purchase products funded for Q1 of 2021. Obviously, it's no surprise they're conforming 30-year is the largest share, but non-conforming 30-year and actually non-conforming jumbo products in general are making up a very large mix of the products. So non-conforming 30 years to 20%, agency jumbos at 30, agency jumbo 30 at 8%, and then your non-conforming arms, VA jumbos. I mean, there's a lot of non-conforming jumbo business being done and really starting to pick up and gain share here. Just looking at it kind of from a different view here. This is just showing for Q1 of this year. Again, it's looking at the entire across the US of our benchmark for purchase funding volume. Kind of what the distribution is, just kind of a little bit more detail, a different view of that graph. Again, I think what's interesting to note, the agency jumbos are up by over 110%, 111% here. Non-conforming is up by over 50%. So again, a lot of growth in some of these, again, jumbo and non-conforming items. I'll say what's not on this list. We're seeing 100 and almost 70% growth, over 100% growth in non-conforming 30-year interest only, non-conforming 10-year IOs, and then non-conforming arms with a year or less are actually up by 650%. Now, granted, we didn't include them on here because they make up a very small percentage of the overall volume, but I think it is important to know, important note that those IO products and non-conforming arms are really starting to pick up in volume. So this is for the entire US. This is looking at just the East US here. So fairly similar to the entire US, and also with the growth of kind of some of the smaller volume products or smaller distribution of products. The IOs are all up by almost 200%, and 1 year non-conforming arms are up by about 700% for the East states. Again, agency jumbo is up by 138%. Non-conforming 30 is up by about 49, so very close to the 50% we saw for the entire US.
Hey, Brent, before you go on, we've got a question on this slide. On these rates, are these all 0-point programs?
Yeah, this is John. So this is the net rate, the rate that the borrower closes on. And what we've found is that with the literally in many cases here, you see thousands and thousands of observations, is that borrowers tend not to pay a lot of closing costs, lender closing costs. So we feel that the borrower note rate is highly indicative of the economics of the transaction. In fact, I believe that we've seen recently that the average closing costs for lender closing costs is around a net of about 1/4 of a point. So borrowers tend to pick a note rate where they're not having to come out of pocket. So it's not a par rate per se, but basically, unless lenders have different business models where they tend to collect more or less closing costs from borrowers, that closing cost tends to come out in the wash, and we find that the note rate that gets closed is the best and most indicative of the economics that the borrower is experiencing across these different product types.
Great, thank you.
Appreciate the question. That's a great question. We are tracking also, just as a footnote, we don't have it here, but we're tracking transaction costs as well. So we do, from many of the lenders that we direct source all our information. We also have all the data elements that go into the closing statement. So we do have visibility behind the scenes here of transaction costs across those different dimensions of closing cost statement, all the detailed information there. We additionally have price concession data. Basically, if a loan experienced, if the lender gave the borrower a price concession, and if so, the amount of those of that concession. So we do have additional price information that's not represented here.
John. And kind of shifting gears a little bit, still looking focusing on strictly purchase volume. Sorry, my slide not wanting to move. There we go. Okay. Focusing on the East Coast, but looking at it from a geographical perspective, so breaking it down by state. And I kind of just filtered this by the states with the largest volume change. Again, this is looking at just purchase volume for Q1 of 2021, funding volume, and looking at all product types. So you'll see, the overall entire US is up by about 33%. Vermont was up by 89%, Connecticut 65%, and Maine up by almost 59%. So seeing the largest volume growth in these, these three states. But you'll see actually, overall volume is up across all states. And then, just included the average loan size. So that was kind of, interesting across what states had the highest average loan size as well. And then also just kind of highlight the average credit scores here. Then this next slide, I've got it broken down by conforming, government, and non-conforming. So, taking that previous slide and then slicing it out and just focusing on, conforming, again, Q1 funded purchases. Vermont, New York, and Connecticut are up at the top. Vermont and New York are, over 90%. Connecticut's at 73. West Virginia is a close 72. For govies, Vermont, New Jersey, and New York. Vermont's leading the way again at over 80%. And then for non-conforming, thought this was interesting. Wisconsin, South Carolina, and Missouri are the largest growth. Wisconsin at 144%, with an average loan size of $774,000. South Carolina is in at almost 82%, with one of the higher loan. The average loan size is a little over almost 1.2 million. And then Missouri is at 78%, with the loan size kind of in par with Wisconsin. So again, just kind of slicing this data in a little bit of a different view to, again, understand where the volume's happening and what it's looking like. So again, that's kind of a high level of of the overall purchase market, what's going on here. And now we'll shift gears to kind of our final bullet point of the market's reaction to the GSE delivery restrictions.
All right, thanks, Brett. So I was kind of in a dilemma here whether I should mention or give the disclosure that I spent 15 years of my career at Fannie Mae, having been at a GSE. And given this topic and what's going on in the market, it's kind of a interesting circumstance with the applicable, these delivery restrictions being applied. But we might as well get into it a little bit here. Your numbers, I'm sure. We do track lenders, individual numbers that participate with us, that provide us origination data each week. And again, we're direct sourcing this information from lenders. It's not recording data that you're seeing, as actual application rate lock and funding information. And then for our first view here, we're going to show you in the yellow line the delivery limit, that restriction, that 7% limit. This goes back to April of 2020. The far right is the most recent period. The 7% is that GSE delivery, non-owner and second home delivery tolerance. And the dotted blue line, the light dotted blue line, is the data that we're receiving from dozens of lenders every week. And this is lock information. And again, we collected every week lock information from dozens of lenders that represent about half of all originations across the country. So we think it's statistically reflective of the overall market. So we see here for conforming, about a year ago in April, it was about 7% combined non-owner second home percentage of the market. That continued for at least till July. Then we saw a bit of ramp up there in August, September, running around 8%. That blue line, light blue line, is a running 13-week average. The dark blue line is a 52-week average. But you can see really tracking that dotted line. Even recently, locks plateauing at a 9.7%, so almost 3% over subscription, if you will, of locked loans happening in March. Very significant business problem. We do see that number starting to come down now as lenders start layering on delivery fees onto those property types. Some lenders discontinuing doing refinances for these second home and investor loans. So we do expect that dotted blue line to continue to come down. But you can see the business problem this year from the outset of the first of the year, going from kind of an 8% number up to almost a 10% number in the course of 2 months. So huge issue for lenders. And the next slide shows the same thing, but this is from a funded perspective. So you think about locks as what will happen, and think about funded loans as what did happen. Funded loans, similarly, you see that back in April, 6% level, shifts up to about 7% in July, chugging along, drifting up towards 8% as we got into December. And then you see a big spike at the end of March, up towards or above 9% of loans getting done, getting funded at that level. So of course, difficult to change, move the tanker, navigate the tanker once loans are in the pipeline. And you're seeing this in the funded. So the locks, we did see things starting to trail off a bit, but fundings we're continuing to see increases, which obviously doesn't solve any problems here, but certainly helps you put in context what you're experiencing relative to what the industry overall and your peers are experiencing. So in terms of a takeaway, and Britt and I will kind of go back and forth here. Obviously, if additional questions, Andrew, I appreciate your earlier question. If anybody else has any questions, throw them in the chat here, and we'll tackle any topics that might be of interest. But we really thought, okay, what's going on in the market today? Trying to get to the so what of what's going on. Obviously, the GSE delivery restrictions, with the market potentially shifting to a purchase market. Hopefully you got some good insights into what's going on, what's the profile of the purchase market from a state and loan attribute product type perspective. We looked at cycle times, which was the biggest issue last year by far. Are 30, 60, 70, 80, 90 days cycle times, how are mine comparing to others? Hopefully we gave you a good point of reference there as well. What all those things have in common is getting transparency into the market. Whatever your data source, lots of your vendors, your mortgage insurance companies, your GSEs, your technology partners, all those folks have data, and they can all help you understand and gain transparency into the market. Obviously, what we do is that's what we do for a living here. Is that transparency into the market to help you understand whatever the hot topic of the day is, whether it's refinances, cycle times, whether it's product mix, maybe focus on jumbo loans and what's selling in the market there. What do I need to have to be competitive? Maybe it's understanding your margins, your distance and your average rates relative to others. Or perhaps it's this GSE delivery issue that people are contending with. Is that transparency in the market that gives you that more informed view of your performance and hopefully the ability to make better decisions.
Excellent. Well, thank you both so very much. Certainly do appreciate you going over the numbers with us. I dropped a link in the chat. This is focused on the East Coast, but Britt and John will be back with us on Thursday to go over the West Coast numbers. So please feel free to use the link that I dropped in the chat to register for that as well, and you'll get the full picture coast to coast of what's going on and the so what of it all. I just had a quick question, John, on the GSE delivery restrictions. So do you think that spike in March was a race to the end, so to speak?
Yeah, I think a number of lenders on a sort of anecdotal basis here got caught maybe a little bit behind the curve. And I think any loan officer with loans in pipeline and those in the market trying to get things done, race to get their deals incorporated. We've heard a lot of different conversations that the GSEs are having with clients, and those conversations don't seem to be consistent. And perhaps you've heard that as well, Tony, at TMC, and I'm sure TMC is extremely active in that topic. But we do hear a wide variety of feedback points, whether the GSEs are asking lenders to manage down the numbers, or if they're asking them to manage to the number, whether that's to the number now or if it's to the number over time, and what the consequences would be if you were not managing to the number, however you're supposed to manage to it, what those consequences are. All those things seem to be a lot of different answers we're hearing, and I'm certain the folks on the line here could tell their own stories. But yeah, I think there was a race to get things locked in. People are layering on price hits and trying to push that business away. I think we're going to see it as it started to trend off on the lock business. We're going to start to see that, I think, dip considerably more. And then, eventually the capital markets, secondary markets will respond, and alternative executions will come about. And whether those executions are better than GSE execution or the same or maybe worse, those executions are sorting themselves out. It's this interim period where people are worried about liquidity on the tails of their business, and it's a very significant business problem. But I think in 3-4 months things will have worked themselves out, And then hopefully we won't have to go through a similar exercise in the future.
Well, this is TMC Connect. One last chance to drop your questions in the chat or the Q&A. Thank you so much for the questions that did come in. The presentation will be sent after via email. We'll also tomorrow be sending out a follow-up email from, looks like we got another question. Have you heard anything from the GSEs on what penalty will be for those that exceed 7% on the NOO or the second home, non-owner occupied?
You know, I haven't heard from the GSEs. We don't have a line of communication into them. The question is a fantastic question. We've heard that it could be a repurchase requirement, and that would be, you would think, the outside issue, because that begets a whole nother host of problems. Because if you're repurchasing loans, a whole bulk of loans, that causes securitization issues for the GSEs. So I've heard repurchase as being a remedy. I can't imagine how that gets affected, implemented without it having downstream consequences. So yeah, we don't have any direct communication with the GSEs on that, just hearing from lenders like yourselves on what they're hearing. But you would think repurchase would be the worst outcome. I don't know that there's any interim other outcome, unless they just say, hey, listen, we're just not going to buy loans from you anymore.
I think that's also in flux. Not sure what the final say will be on that, but well, thank you very much. We will, as I was saying with the email, we will send over a link to the recording via YouTube and the podcast. Podcast will be missing a little bit because of all the numbers that we went over, so probably just YouTube. But thank you, Britt Haven. Thank you, John Sayer, for giving us your insight and your analysis for the first quarter of 2021. And once again, please join again on the 22nd for the West Coast analysis. And for TMC Connect, we really appreciate your time today. Thank you so much for joining us, and we hope to see you in a future session as well. Thank you, everyone. Have a great day.
Thank
Thanks,
you.
everyone.
Bye.